no one's richer. The economy's not doing better, but because everything costs so much more, the GDP number went up, even though the debt stayed the same. Once a country gets over 125% debt to GDP, there's like no coming back from that. Really, when you get over 90% debt to GDP is where what we'd call Keynesian multiplier really starts to drag down. So because the goal is that I get 50 cents of debt to get $1 of growth. But over 90% of the debt GDP, I'm getting $1 debt for $1 growth. Once I start getting over that, now I'm getting 50 cents of growth for $1 debt, which means I'm just digging myself deeper in the hole. And so to your point, there's really only 4 ways out of it. Austerity, living on a budget. Nobody's going to do that. 2, defaulting. But as you said, right, no money, no government with a money printer would ever default. They can't tax it because there's not enough money. Even if you take all the rich people's money, there's not enough money. Plus there'd be revolt. And so finally, it's the theft, right? And so it's financial repression. It's something that we saw back in the 30s and the 40s. So just most people alive today haven't seen this before. In 2015, the IMF put a paper out actually titled Financial Repression, where they break it down. And it's basically what they do is they want to keep your money in the system so they can steal from you. Now, if you look back to the history of nations collapsing all the way back to the Roman Empire forward, one of the last stages that a nation will do, and you'll see this, modern day today, Turkey, Lebanon, et cetera, is it's called capital controls. They want to keep your money in the system so you can't get out, because obviously if you can get out, you'll leave and the system collapses. And so financial repression, one, requires those capital controls to keep your money inside the system, sealing off the exits. And then what they do is they want to inflate it away and steal it from you. So one, trapping you in. And the idea is that inflation is running higher than bond yields are paying. So what we'll see over time is more and more money will be co-opted by the state. So what does that mean? That means your pension funds, your 401ks, your mutual funds. The state will just start forcing all these corporations, all these retirement plans to invest into the government bonds. Back in the 30s and the 40s, it was do your part, buy the war bonds, right? It's your civic duty to do this. Now it'll probably be more forceful, like, hey, this money, all these retirement plans, et cetera, now have an increased requirement to buy bonds. And so then the bond yield will be lower, say, like it was like 0.25%, 2%, 3%, 4%, but then inflation will be 7, 8, 9%. And then they'll steal the difference in the middle, forcing you to keep your money in, inflating it away. And then, the way that we got out of this in the 30s and the 40s, if you look at the chart, you can see the debt to GDP did get up over 120%, but they were able to bring it back down. And this is how they did that. Inflation ran really, really hot for a while, and they inflated their way out of it. So what happens is when you inflate your way out of debt, we have the debt to GDP. Those are 2 levers. That's 2 sides. Debt, that's the amount of debt, but it's a ratio to the amount of GDP. So if we let inflation run really hot, then the GDP numbers go way up. So no more goods and services are being created. It's hocus pocus, right? There's no one's richer. The economy's not doing better, but because everything costs so much more, the GDP number went up, even though the debt stayed the same. And that's kind of the magic trick that they'll pull. We also saw this, like I said, we saw in the 30s and the 40s in the US. We also saw it in the 80s in Israel. They saw triple-digit inflation for about 3 years to do this. And so that's most likely what's coming. I have a newsletter that we write, and we kind of have a system. So we help people really hone in and identify exactly where it is they're going and help them think through all that. We have a bunch of tools and sheets they can use, and then also figure out where they're at and then help them make that plan. So the system is a series of questionnaires and tools that we have to help you identify, be clear on that. And then we have the newsletter that then identifies which assets that you should be buying. And we kind of put them into 4 buckets, or as I call them, 4 pillars. So investing for growth. This kind of gets back to the Bitcoin stuff, the commodities, things like that. Energy, investing for cash flow. Of course, I talked about that. Keeping cash as one of the 4 pillars. And then I call chaos hedge insurance. This is gold and things like that. And so then once you figured out what your exact allocations are, where you're going, where you're at, then we write the newsletter that recommends the assets that you could put in that, tracks them in a portfolio, has a community so everybody could be in there sharing information, working together towards a common goal. And it's been really successful. I've been writing that for several years. And it's a lot of fun. Hey, this is Mark Moss, and you are watching Think Smart Education.